Hi, it's Frank Cappelleri from CappThesis. It's a pleasure to be with you here again on Stockcharts TV. So today we're going to be going through a full market update. Look at a number of indicators that suggest that the S&P now is short-term overbought. We'll look at the S&P 500's two recent price targets that it just achieved last week. We'll be discussing also a long-term trend indicator that just flashed a bullish signal. And at the end, we're going to go through a recent trade idea that you definitely will want to stick around for. So let's start first with the recent RSI divergence. I'm talking about negative divergence, which was in play for the last few weeks for the most part. And as you recall, before the market really took off to conclude June, the second quarter, and the first half of the trading year, things really kind of slowed down a bit in the middle of the month. And so that resulted in the RSI, the 14-day RSI here on the bottom, making a lower high as the S&P 500 itself was making a higher high. Now we know that these are not signals. These are warning signs that we should at least be aware of because they actually play out every so often, especially the one that just happened earlier this year. In fact, this really started in December. Remember, as the market was making new highs to start the month, led by large cap growth, it did create a very marginal overbought reading in early December. And then as things continued to back and fill over the next few weeks, S&P 500 again made new high to start the year, but we did not see that reflected in momentum, right? We saw the momentum with the RSI continuing to make lower highs. In fact, by the end here, mid-February, could hardly really get above the 60 zone as the S&P was breaking out to new highs. We know that breakout was marginal. But at the time, there were other indicators as well suggesting that momentum was fading. And just looking at the pattern work alone, we reviewed that at the time that was one of the numerous failed bullish patterns that have started to pop up, which was a big change of character to what we saw in 2023 and 2024. So when that failed, of course, the bottom fell out of the market, and we know the reasons behind it. At the same time, we saw that momentum starting to shift and not confirm the trend before that happened. So with that happening again over the last few weeks, after a huge run in a very short amount of time, as the S&P was getting back close to not only its former high point, but resistance points in areas that it had failed at numerous times over the preceding months, it at least gave us a sense of pause to at least see what was going to happen next. So as we know, after that, well, we did see a little bit of a pause, but as we know, the drawdowns have been really non-existent at this point, with the S&P ending up making a new high as well. And we know that in the strongest uptrends, this tends to occur every so often. You're not going to have a continuously overbought RSI reading, even if the market is making new highs. It kind of ebbs and flows. And the most important thing from an RSI perspective, right, is seeing it for the most part oscillate between overbought and near the midpoint. So it's not going to be perfect, but for the most part, we understand how that works, where in a downtrend, just the opposite occurs, where the RSI itself staying relatively below the midpoint and not getting back to overbought at all. So anytime the market does get overbought, you hear a lot of people talk about the last time that happened and citing all the times when the market then rolled over. But I think it's much more important to view it in the sense of when was the last time the S&P first got overbought and what happened after that. So we want to look at it this way instead. First overbought readings in at least 2 weeks. So we use 2 weeks because it gives the market a chance to reset at times. And so if we go all the way back to the low from October 2022, we can see that there's been a handful of times when the S&P 500 got overbought. Not surprisingly, that happened as the market was rallying for nearly 2 years. And really only one time here did it come close to nailing a top. That was just about 1 or 2 weeks before the July 2023 top. And remember, after that, we had a 3-month correction with the S&P 500 down 11%. But from that point, all along the way, there were numerous times when the S&P hit overbought on an RSI basis, which confirmed the move all the way through. So that takes us to right now, where on the comeback here, this is now the second time the S&P 500 has been overbought. The first one coming right in the middle of May that led to just a minor pullback of about 3.3%. That was enough of a dip for investors to put buy orders back in. And now here we are again, making new highs once more with another overbought reading. Now, this time is different, of course, because it's happening as a market is going through a major potential breakout to new highs after coming back from a huge volatility event, right? And so why don't we look at the last few times that occurred, being overbought while breaking out to new highs. So if we go back to 2018, these are the three key periods when that happened. And they share some similarities as is pretty evident here. And so going back to 2019, now this is coming from after the bear market or the 20% decline in the fourth quarter of 2018. You remember that very well. And that, of course, led to the V bottom that followed with the S&P rallying all the way back up to that zone by the early part of 2019, and eventually leading to another huge up leg to conclude the year. Now, it wasn't a straight shot higher though, because right here, as we have highlighted in yellow, first in May, but more so in August of that year, there were a handful of big declines that month, which seemed to put that uptrend in jeopardy. Of course, that was digested very well with that really strong and persistent fourth quarter rally following. And that brings us to COVID, of course, one of the biggest declines ever in a 6-week period, and one of the biggest rallies to follow, of course, as well. Now, the same type of thing, where we know that it led to a very strong move to the end of 2021, what do we have to deal with first? Right around that breakout to new highs, right around a breakout of a huge pattern here, there were two different 10% corrections along the way. And so, again, didn't feel great sitting through, but the market was able to digest that, and which then led to the second part of that rally and a much more consistent version as well. That brings us to 2024. Now, remember, coming all the way back from the bear market low, now not quite as quick of a volatility event as we saw in 2018 and 2020, but still, this was a more elongated bear market, so it took more time to come back. But once we did get back up to that prior high, some more consolidation, not that much, of course, but enough to form a potential right shoulder here, and then finally getting through that while overbought, again, led to numerous months of follow through. So again, what we want to see here, once more, is getting back to new highs and overbought once more. Now that may lead to more sideways action, a digestive phase, which we haven't seen, of course, since the April lows. But what that would do is maybe form a better foundation of which to then have the second part of this move get going, like we saw in late 2019 and through all 2021 and from January to December 2024. That's how big breakouts to new all-time highs that have overbought readings can work out. And so one of the lagging indicators that you see a lot of times the market comes back is just new 52-week highs, where according to Stockcharts.com, data, of course, provides all of these internals for us to use, which makes it extremely helpful to gauge the internals and the breadth of the market. And so, as we can tell, 41 compares to the highest point that we had in 2025, which was just 61, both of which are way below the peaks that we saw over the last few years. And we know that this typically is a lagging indicator, because if the market itself is coming back strongly, it's typically led by the biggest and most influential names, which it was, of course, now. So it can just move at a faster clip and get back up to its highs much more quickly than, say, the majority of the stocks will. But eventually, if you get to the point where you're making new highs and continuing to go higher like we were through most of last year, then that number can spike. Right? So that's what, of course, the next goal is from a new 52-week high perspective. Because if you look at some of the stocks and you can rank them by closest to the new 52-week highs, there are a lot between, say, 0 and 5% of their highs, where that number can move quickly if the market continues to extend. So the question is, once we get a lot of new highs, in this case over 100, is that going to be another confirmation that the market is going to go much higher? Not surprisingly, from the late October 2023 low all the way through the end of 2024, we saw more than 100 stocks make new 52-week highs, 9 different occasions. And that did confirm the move. It showed that there was an expansion of names making new highs, and that's, of course, good. However, on a very short-term basis, it actually wasn't the best time to buy when those popped up. As we can tell here, at the very least, the market paused. At worst, it led to big pullbacks, right? And so looking at each one of these, so it took about 2 months or so for the market to finally hit 100 new 52-week highs in December 2023. Now that led to just a consolidation phase, but one which we wanted to wait and see what would come next, because again, the market was up a lot in a very short amount of time, but just moving sideways was able to kind of neutralize some of the overbought readings, setting the stage for the next up leg. And that led us to March here. And as we know, more new 52-week highs, over 103 different times. So the market did float higher through most of the month, but crested as the month ended. And at the same time, some of the short-term bullish patterns that we were watching started to peter out as well. And so as we can tell, soon thereafter, S&P had undercut the spot where we've got that other 100 new 52-week highs once more. Brings us to July, basically nailed the top right there, right? With the pullback that was extremely strong, about 10% in a very short amount of time after getting more than 100. And then back to October and November happened a number of times. And again, market floated higher after that, but did not do anything worth chasing because of all the failed moves along the way, and clearly wasn't the right time to buy there as well. So how do we use this really? We want to see, of course, those new highs expand, and that will help confirm the move if bullish patterns continue to work. But if and when we do get the next 100 reading, probably not the right time to put new short-term long positions on because of what we've seen in the past. It is a pretty good indication of a short-term stretched condition. So if you like this kind of content, I urge you to check out CappThesis.com. Of course, this is where all the content comes from. We provide charts, stats, and other videos like this as well for our premium clients. Again, CappThesis.com. Check out the different plans that we have there and decide which one is right for you. Now back to the video. And so also Bollinger Bands. Not surprisingly, as the market has come back, you can see that the S&P is now above its upper Bollinger Band. And as we know, Bollinger Band is measured 2 standard deviations above and below the 20-day moving average. And Stockcharts.com gives us the ability to look further into that by using the percent B indicator, which you can find in their list of indicators and put them on the chart. And I found that very helpful because the percent B basically just measures the security versus both the upper and lower band. And so as we can tell, the extreme points of the percent B, at least going back to the beginning of 2024, has been right around 1.1. Hasn't gotten much more than that. And that's coincided with some of the biggest downturns, or at least stopping points along the way in red, as we can tell. So this is another chance to see how the market would do with that. And I say chance because if you go back to, again, when this really started in late 2023, there were times when simply getting back above that and creating an extreme overbought reading from a percent B perspective did not lead to pullbacks, right? Especially early on here. You see this in December, early January, again in June, market continued higher. And so that just tells you that investors were willing to buy any dip, any pause. So if that's the case again now, they can just tell us that maybe the pause isn't coming, that we're going to have to maybe move even higher at this point, float higher, climb that wall, worry more before we're seeing a bigger pullback. So at the very least, it's a good gauge of how strong this trend is. So in terms of patterns, as the S&P was moving higher and making new all-time highs, we have 2 more bullish price targets being achieved last week. The first one was 61.20. We talked about this one before, coming from a pattern on a 2-hour time frame here, broke out, got tested a few times along the way, but finally, as the market continued higher toward the end of the month, hit that target last week. So that was the second bullish pattern target that we've had since the lows. The other one was also on a very short-term basis, and that was 58.40. Then what about the longer term or the bigger patterns? Well, the biggest one we had in place from the beginning, at least, was this cup and handle pattern. And it was very important because, again, very big, still not in terms of length, not big, but big in terms of how high that pattern was, because we were measuring it from the April low. And this was the first one that we had used the April low for. So this produced this pretty clear cup and handle pattern, got tested within a few days, as we know, and then it's continued higher and eventually got to that one too. And we talk about this all the time, where the smallest patterns that work then help build bigger foundations and bigger patterns like this as well. So that leads us to the next one, which has a target of 65.55. And so this one hasn't been tested at all because it got triggered on that gap higher on May 12th, and it continues to be with us. And between this and the even larger target of 67.45, of course, the more or the further that the S&P drifts higher, the bigger the cushion that it creates of which to pull back. And again, this is important because if these targets, even higher ones, are going to be achieved, we just need smaller formations to continue to work out. And again, we talked about this in the past. That's really exactly what happened in 2023, 2024. And so here's the updated pattern grid here. Both of those smaller ones have been achieved. And now we just have two larger ones, both of which were triggered on May 12th. But we could talk about an even bigger pattern. And that is this one, which could be attached to the most recent highs. Now, this looks pretty similar to the one we had talked about from 2024 when the S&P was breaking through 4,800, which produced a new high to 6,100 because that was measured off of the 2021 high. Now, this is, of course, the 2024, 25 highs. So this whole thing here, or thereabouts, could be a left shoulder with the head again being here into the April lows and the proposed right shoulder being somewhere here. And we have to see how this plays out because originally we had drawn this line horizontally across. And so the target would be, say in the mid 7,400s there, which is of course much, much higher, but that's just a measure move. And depending on how to draw this upward sloping neckline, that number could be much higher, or it may not happen at all. We have to wait much longer for this to break out. But this is definitely one we'll be watching as we get through July and the summer months. And so in terms of the trend, we look at the go, no-go charts for that. And one thing we have been waiting for is that for the weekly go, no-go trend to turn positive and give us that go signal. And it finally did after the last 2 weeks, and of course got even stronger after last week's strong move to end the week and almost conclude the month as well. That's important because, as you can tell, this is happening as two of those big patterns are starting to break out and potentially a third one through the highs. So that's typically what we saw along the way. So if we go all the way back to 2009, is give you some of the examples of when this worked out. And so we can see that it was in the middle of 2009 when we finally went to go. Again, off the lows, but at the same time, you can see how this coincided with a huge pattern breakout, which of course led to additional price action or additional uptrending action. Something similar here in the middle of 2010, we had some volatility, finally broke out through a bullish pattern here, then the trend turned positive and continued higher. Say the same thing for 2011. A lot of volatility, as we know. Here's a low in October of that year. Finally turned to go again as a breakout was occurring through a bullish pattern, making new highs. That led to multiple years of uptrending action. Now we go to 2015, 2016. A lot of back and forth movement. We know there was a big rally at the end of 2015. It failed back near the summer highs there. Coming off of the February 2016 low, that's when things started to change. And as we can tell, this became positive right before a big pattern breakout. And then, of course, 2018, 19, big V bottom, finally got that breakout. We talked about how there's back and forth movement here toward the end of the year and then moved higher. And then, of course, COVID, right? Back and forth. Took a little bit of time for that to turn positive once more. But once it did, we call this another bullish breakout, and then correctly led us through the end of 2021. And so again, we use this as a complement to our work, and it's very helpful to see this again offered by Stockcharts.com to see the bullish patterns alongside these, the biggest ones. So when you have the biggest turns higher in trend or momentum after a big volatility event and bullish patterns start to work, as we just saw, two powerful technical factors working together, and those are the ones we'll be relying upon as the days, weeks, and months progress. So I want to talk about one recent trade idea. Now, as you know by now, most of the trading recommendations we use are based on classical chart patterns, right? Breakouts through head and shoulders, inverse head and shoulders patterns, cup and handle, usually looking at stocks that are in uptrends, breaking out to new highs, or just forming some bullish patterns. Over the last 2 months, for example, we gave premium clients 40 different chart trades, as we call them. And so with the market moving higher, of course, most of them have done well. But on occasion, there are some examples that we want to look for some mean reverting moves, especially in areas that have underperformed, that have shown in the past the ability to come back. And one in particular, as you probably know by now, is Apple. Right? Apple has underperformed just about anything you put it next to over the last number of months. This is Apple versus the S&P 500, versus the NDX, NASDAQ 100, versus the XLK technology ETF, versus the MAGS ETF. Again, Stockcharts.com gives you the ability to look at anything on a relative basis, and I urge you to do so because it gives you a very good idea of how that particular security is doing. We know what it's doing on an absolute basis, but on a relative basis is just as important, if not more important, because if it's moving lower, that means we're losing money versus something else, right? It's opportunity cost. So looking at Apple now on an absolute basis, the pullback has been severe, right? From the high in late 2024 down to the April low, down 35%, which of course is much bigger than anything we saw going back to 2021. Now, we're using intraday data here, so maybe it isn't that severe if we don't include what happened in April there. At the same time, as we can tell, it's down a lot and it hasn't really rallied as much as we can tell by those relative charts. But what do we know about these last number of big declines that are followed by extremely strong mean reverting moves? In fact, each one of these ensuing bounce backs were bigger than the prior declines, right? And so right now, as of just a few days ago, this is what we showed in our most recent piece on Monday morning. Apple is up about 18%, or was up about 18% from the lows. Not bad at all, but again, compared to some of these other areas that are up 40, 50, 60% or more from that time, it really hasn't performed well. And so from that point, it's really trailed, and of course, still a good deal away from its highs. So another way of looking at this, again, looking at those same rallies, almost each one of the biggest rallies all happened right around the same trend line here using log scale. And so similar to what just happened in April, Apple undercut that line, now back above it, again, up 17%, still much more to go. As of last Friday's close, Apple was more than 30% away from its high, so it could have a good deal more to make up. Not only that, over the last 4 big mean reverting moves, 3 of the 4 times Apple overtook its most recent high. The only time that did not happen was during the bear market rally in the summer of 2022. Remember that huge head fake? But the S&P itself hit its 200-day moving average and then completely rolled over. Apple was part of that. Every other time, though, and especially right after that, the ensuing rally overtook the prior high. So if that were to occur again, then the target would be above its last high from late 2024. So if you think about it, last time we reviewed the XLK ETF, technology ETF, getting close to new highs, now above it, and how the prior 4 times it did that, it just completely took off and went much higher. For that to happen again, you have to assume that one of its biggest components, Apple, would finally have to participate. And remember, rotation isn't just about rotation among sectors. It's sometimes within sectors as well. And if some of the bigger or best performing XLK stocks or Mag 7 stocks have to take a break, which they will relatively soon, some of that capital may find its way to one of the most influential and biggest underperformers that there is right now, Apple. That's it for today. Talk to you again soon. Thank you.